Oh, hello everyone, it's Susie again from Esoteric Trading Solutions. I hope you're all well. I hope you're being kind to yourself, looking after yourself, being kind to your beautiful animals, your beautiful pussycats, your beautiful dogs, whatever animal you've got, and just being kind to people in this world just to make it a better place. No matter what's going on in the world, we can't lose our empathy and our kindness just to people and to animals and to the environment and everything else. And also I'd like to thank people for supporting my Patreon. I really appreciate it. It enables me to do a lot of better content and more content, and there's so much to talk about, whether it's fiat markets or crypto markets. And this, within Patreon I also do lots of different cryptocurrency reviews as well. There's so many opportunities in cryptocurrencies, as you know, but again, there's well over 5,000 coins, and it's like trying to find that opportunity through the haystack, okay? So if you do Patreon over $35 plus, you get cryptocurrency reviews. I'll put probably at least 2 in there a week. And I'm looking at one now which looks pretty interesting, and there's not bad value as well, which is something different to what other people have come up with. So I work very hard, but I do really appreciate your support. So thank you very much for that. A fellow that I really like is this fellow, and I'm assuming it's his name, Tyler Durden. He comes out with some really interesting articles, and I've mentioned him before on Zero Hedge, and I'll put that up on the YouTube in the details section. He talks about gold soars along with everything else as the Fed ends capital markets as we know them, and I think this is a very true statement, actually, I have to say. As you know, the Federal's actions meant, he said that what the Fed did with the 2.3 billion injection to the markets, the free markets as we know them are actually dead. And I have to honestly believe that, because the Fed is the biggest investor in markets, and you can't go against the Fed no matter what the economic fundamentals are doing, or whatever's going on at the ground level with the people. The Fed's in there in the financial markets, and it affects all markets: crypto markets, foreign exchange markets, corporate debt markets, equity markets, commodity markets, high yield markets, mortgage-backed security markets, treasury note markets, all sorts of markets, and even crypto markets, as I said. So really interesting. One thing for sure is gold is looking very bullish, and I've mentioned this before. As you can see with this chart here, the thing is, gold and physical gold, it's very difficult to get physical gold. The futures of gold, which are the forward price projections of gold, are actually higher than the physical gold at the moment. Apparently you can't even get gold coins or nuggets or anything like that. And it does tell you, if gold's moving up, something's certainly going on within financial systems. People tend to buy gold when they're concerned about the way economies are run, and where they're concerned particularly about the politics of economies globally, and they're concerned about whether fiat, whether it be US yen or whether it be Euro US, is going to stay at the levels that it's going to stay at, or whether they're actually going to fall and devalue quite dramatically, which I suspect going forward, fiat foreign exchange currency will devalue quite quickly, particularly because, as you know, with the Fed, they keep just issuing and printing money, and there's no backing to that money. And where does the funding come from? Again, if you don't have China or Japan buying the T-notes or the treasury bills or whatever they are, if you keep printing money, this is, you know what happened in Germany in the 1930s, before Hitler came into power in 1933. You keep printing money, you create hyperinflation, and the German mark became absolutely valueless, because you keep printing money. It's akin to you keep selling money, okay? And that's what happens. There's nothing backing it, there's no balance sheet backing it, there's no gold backing it or anything, and you keep printing money, it becomes valueless. And that you've seen that with every other economy in the world, whether it be Zimbabwe, whether it's been Venezuela, whether it's been Bolivia, many African economies, countries as well as in South America, whether it be in Costa Rica with the Coriel, I think it's called, which is an unusual currency. So something is telling us something's going on, particularly with gold. Now, I'm of the view that inflation is high in the system. It's been high in the system for 20 years. So it doesn't surprise me that gold is going up. gold is a hedge against inflation. I don't believe that inflation is low, that our purchasing power of the dollar has gone further. It hasn't. As a matter of fact, it's costing us more and more to live every day, whether it be food, whether it be utilities, as I've said. So what we've got is spot future gold prices and future gold prices. There is a big divide between the gold futures, which is the forward price, and the spot gold prices. Now generally they're not, the divide is not so large, but we're now starting to see it up, you know, around $50 or so, and that's getting worse and worse, okay? And you know, that is going to get even bigger and bigger. And you know, gold looks, and I've said this before, gold to me looks like it's going to go parabolic, okay? There are definite shortages in the physical gold. You can't get it apparently, and it looks like it's going to go parabolic. Now the thing is, if markets weren't so concerned about the policies that the Fed's doing, and if you want to call it the World Central Bank at this stage, you wouldn't see this situation with gold. Also, you know, inflation in the system and devaluation of currencies, okay? The US devaluing plus the euro and every other major currency that we know, okay? And that's what's happening here. And, you know, the markets are telling us something, absolutely. And also, you know, if you look at the internal mechanisms, even in London, where gold is priced in London, you know, you've seen futures being trading more than $50 above the spot price in London. And apparently even London, which has a different type of different ounce, they have what do they have, 400 ounces per contract. In America, COMEX has 100 ounces per contract. They were so shortage of gold in London, they said, can we, you know, switch the contract so that we can at least hedge some of our positions. So this seems to be getting worse. And it's becoming more and more expensive. Delivery in New York is more expensive than in London because there's a shortage, okay? And, you know, the metal, you know, there's problems with transport and trade channels and all sorts of things. Obviously planes, you know, shipping, everything's very, very restricted. But it's not, notwithstanding that, something is definitely going on with the price of gold. And I think you're going to see it higher and higher and higher. And it's simply because governments keep issuing, well, particularly the US Fed, and if you want to call it the World Central Bank, literally, it keeps issuing dollars, US dollars into the market. They're just printing like nobody's business. I saw, you know, a stat, it was like something crazy, like $60 every second or something. You know, now they've got debt of something like 24 trillion. They must have put through, you know, a new debt ceiling to open up as much as they can, because generally, you know, a couple of years ago there was a debt mandate to how much debt they were allowed to print, but obviously we haven't heard anything about that, so they must have snuck that through the Senate. So pretty much, in other words, governments are almost fully taking over free markets with the proper principle dethroned as the key business driver. And they're certainly looking after, and like I said before with my previous YouTube, they're looking after the 1% only. Someone on my previous YouTube said that she worked as a nurse in hospital with the coronavirus, and even with this pandemic, other nurses and other people that work in hospitals are being put off, and they're trying to get unemployment benefits, and they still can't get through even after 300 calls. So it seems like it is a thing right across the board. It's certainly the same in Australia. People cannot get help, and it's really scary where this thing is going, that's for sure. And as this article says, with the Fed doing what they're doing, it really changes the rules of the game for investors. You know, effectively, it tells Wall Street just to stay long and get long, basically keep buying equities no matter what, because the Fed, like in 2008, is going to bail you out no matter what. No matter how much money you get paid at the top, you know, you don't have to take on any risk at all. And generally people that get paid at the top, you know, the big CEOs, the big investment managers, the directors, you know, used to get paid lots of money to take on risk. to take on risk on the balance sheet, to make decisions about acquisitions, to make decisions that were going to grow the company, not actually go and buy back stock within their company, which only benefited themselves, right? And that's what a lot of executives have done. They bought back stock to benefit themselves, and they never had to take on any risk. And in the olden days, you got paid money to take on risk. Now you don't even have to worry about it because the Fed actually bails you out. So you like Jamie Dimon that gets paid 180 million or whatever he gets paid, and the guy doesn't have to take on any risk at all, because all he has to do is sit there and wait for the US federal bank, the central bank, to bail him out. The guy doesn't have to do anything. So the question is, what is he getting paid for? To talk down about Bitcoin and everything else when he doesn't understand the technology. Clearly, he's got plenty of time on his hands, because the guy can, excuse me, talk about cryptocurrency markets and doesn't know anything about them. And like I've said before, I don't talk about mechanics, and I don't talk about being, a car, I don't know anything about cars. I don't talk about the mechanics of a car. There's so many things I don't know about. But if I don't know about them, I don't talk about them. And these people put themselves forward and say, Bitcoin's a scam and this is a scam, but they don't even understand the technology. And just like Warren Buffett, no disrespect, Mr. Buffett, but seriously, if you don't understand the technology and you've never used it, then you're not in a position to be able to say anything about the technology, seriously. And if you don't know something, you shouldn't be saying anything, because people listen to you because of who you are. But the reality is, new technology, if you haven't got a clue, you shouldn't be saying anything. And that's true of anything in my mind, and that's my honest belief, because people shouldn't be putting themselves out there as authoritarians on something if they honestly don't understand something. It's not great. But, coming back to this, certainly the rules have changed for investors. The game has dramatically changed in the last 3 weeks. And this article says, with the events of the past 3 weeks, the perversion and conversion to a dystopian capital market and economic system is virtually complete. Wow, very strong words here. Dystopian capital market. Wow. As for me, with the Fed's announcement of unlimited quantitative easing, it will buy or support almost anything. Along with the passage of 2.5 trillion stimulus package, 2.3 it was. This is the end of capital markets as we know them, and I agree with that. There's an old saying in markets: you can't fight the Fed. If the Fed's buying high yield, if it's buying corporate paper, if it's bailing out hedge funds like it's doing with the 1%, and it's buying equity markets, you'd be a fool to try and short equity markets, right? You just get long equity markets, regardless of whether these companies are going to go broke next year or the year after, because they're not issuing, they're not building up their businesses or writing any revenue. The Fed is just propping them up no matter what. Okay, regardless of whether they've done any business for three months or whether they've done anything overseas, the fact of the matter is, it isn't even about looking at company fundamentals anymore. The big, CEOs, the big directors at the top that get paid millions and millions and millions and get, great deals on company loans where they don't have to pay any interest. They get their kids, school fees paid for. They get, cars. They get cheap loans to buy houses. They get expat deals. They get hundreds of thousands of units of shares in the company. They just make money no matter what. And this just plays into the big rich people's investment portfolio. They've been given shares from the company. Again, it's a conflict of interest. If a big CEO or director says, at the board level, at the director level, let's buy back our shares, and they're holding shares, it's going to benefit them and make them even more wealthier. It's certainly a conflict of interest. And certainly with the Fed, buying everything, it means the wealthier get wealthier and the poor get poorer, and nothing trickles down to the bottom. Okay, nothing at all. And every system we've seen in the world, even communists, is like that. The wealthier at the top and the poor are down the bottom, and the poor are the masses, the people, you and me, for example. It's just, to me, it's a crime against humanity. I really believe that. I know that's strong words, but it is a crime against humanity. When the 1% is looked after, and the rest of us are not looked after. It's just a shocker, and I cannot understand, you know, why politicians do not see that. It is absolutely beyond me, really. You know, it really is national debt. You can say that again. You know, Chairman Bernanke in 2010, Washington Post, he argued that quantitative easing would lead to a virtuous economic cycle. Therefore, the Fed would eventually be able to exit from QE operations. But the reality is it hasn't happened, right? You know, they keep injecting money into the system like a morphine addict because the system needs it and it's reliant on it. It's the only way the system, you know, the stock market and the system can keep going on, okay? You know, the system should be going on at the ground level, you know, where people are supported at the ground level, small businesses supported at the ground level, and people are getting employed at the ground level, not all this money going into the top level, okay? It's just completely bunkum, and it just doesn't make sense to me. And again, this talks about no accurate price discovery in capital markets. Absolutely, and I agree with that, because the yield curve is being kept down to historical lows. The yield curve, you know, a 10-year bond should not be at 1%, not when there's inflation in the system. You know, the yield curve is being kept historically low, so that puts more value in terms of the equity market, because the cash flows of the equity market, most equity fund managers and equity traders will use the net present value model, the discounted cash flow model, to price up their equities with lots of factors that go into that and components. But the thing is, if you've got $100 like a forward cash flow, and you divide that by an interest rate of 1%, you know, say 1, you're going to get $100 forward, right? If you say the interest rate was 2, and I'll do this very simply, say if you had $100 of cash flow forward and you divide it by 2, then the price of your stock's only going to be $50, right? And that's how it works. So, you know, again, if we divide it by 1, the stock's going to be worth 100 divided by 1 is $100 for the stock. But if the interest rate was at 2, $100 divided by 2 is $50. You see what I'm saying? And that's why the market is kept up, the equity market particularly, to unnatural highs, because they've been for years, since 2008, been manipulating interest rates, which in the past used to be the price mechanism and the risk metric for the equity markets. As interest rates were allowed to go up pre the Fed manipulating markets, the equity market would come down because interest rates would rise, okay? And that would bring naturally down the equity market. So then this goes into, you know, this fellow saying, you know, the Fed has completely taken over and controlled the US financial market, and with that, you know, because they're so large, they effectively do it to every other market in the world, okay? And then, you know, then he's basically talking about, you know, commodities and collectibles. It even has a hand in that. The public equity and debt markets are now nothing more than a greater fool markets that are led by the greatest fools of all, the Fed and the Congress. US capital markets, rest in peace. Wow, very, very strong words, okay? When everything is essentially socialized as to risk, a return versus risk evaluation is essentially meaningless since the risk side of the equation has been truncated. And I agree with that totally. You know, just keep buying the equity market, keep buying every bond, every corporate toxic bit of paper, because the Fed's there and they're going to buy it. I mean, seriously, you know, they've completely ruined the capital markets. Not only that, coupled with compliance, and the banks are not allowed to, you know, trade their proprietary book anymore. They've been put in chains. Every proprietary trader, you know, people used to have a job, you know, 15 years ago as a prop trader. Now you don't see them. So not only that, you have less liquidity in markets, less liquidity because no prop traders are allowed who used to make liquidity. Also, all the rules that come from Basel and all the rules that come from all the, you know, Security Exchange Commission and everything, which tie the bank's balance sheet up because they have to have certain ratios. And then you've got the Fed in there manipulating markets. In my mind, this is going to end very badly. You know, how long can they keep propping markets up? You know, once they decide that they're not going to do it anymore, this is going to end up terribly badly, right? You know, and with this, the currency will collapse, just like it did in Germany in the early 1930s. The currency collapsed because they kept printing money to try and fix the problem, and it didn't work. And that will happen in the US as well, right, with the collapse of the currency. So, again, it talks about sovereign, credit risk. 1 year sovereign credit risk, credit default swaps have been going through the roof, and that's what you'd expect to see with markets normally operating, okay? But with the Fed coming in, those credit default swaps will go down. People are actually buying sovereign credit default swaps because they're concerned about the credit risk of other countries, okay? Sovereign means country. So they might be invested in Italy, or they might be invested in South Africa. So they're buying credit default swaps on Italy or South Africa because they're expecting a downgrade, okay? Or Italy may not be able to pay their debt, or South Africa may not be able to pay their debt. That's why credit default swaps are blowing out, going higher and higher. So in other words, me as an investment manager, if I'm holding, say, bonds in Italy, and I'm concerned that Italy is going to default, I will go and buy a derivative like this, a sovereign credit default swap on my Italian bond portfolio, so that I have a hedge. I've covered myself. So if the bonds don't pay out, they hit maturity and Italy doesn't pay them, I've got a hedge on the other side. If I lose on the bond side, my hedge being the sovereign credit default swap, I get paid on that side to hedge my loss on the physical bonds, okay? So, this is not a great story at all. It means the credit quality of countries around the world, the credit quality is actually getting worse and worse, and that's to be expected with this virus, okay? Absolutely. But then at the same time, we've got the S&P going through the roof, okay? Just nuts, absolute nuts, right? The S&P is going to go through the roof, right? Again, we look at, again, we know that the Fed's put in 2.3 trillion. Their balance sheet is getting bigger and bigger and bigger. Their balance sheet all of a sudden is at 6 billion. At the peak of 2008, I think it got to 8 billion. It's the same story. The balance sheet is going to get bigger and bigger because they'll become the biggest equity dealers in the world, the biggest equity investors, the biggest bond investors, the biggest high yield investors, the biggest mortgage-backed security investors. Gee, I hope they've got investment knowledge and investment skill, because gee, they really need to know a lot about buying all those investment products. Seriously, does anyone in the Fed have investment knowledge? Do they know how to assess a mortgage-backed security or a commercial-backed security with optionality in it? All this sort of thing, or with prepayment risk. Again, the Fed must have a lot of knowledge in terms of investment, seriously, because all they're doing now is pumping up markets again and again and again. And when is it going to stop? Seriously, how long can they keep going for this? The Dow is up from its lows, and it will probably move even higher past 29,000 because of all this money. Again, there was supposed to be oil cuts apparently. But, again, the OPEC deal, according to the statement, failed dismally, and looks like oil is going to go lower. The dollar, with this situation happening, as I said, should be going lower and lower. Yields are being, kept short for a long time. But what we're seeing is the change of the yield curve. In other words, the long end of the yield curve is going up higher in yield. And that's not a great story, okay? So the short end is outperforming the long end. We could see long bond yields just move up high no matter what, which will not be good for the equity market, as I said. But what the Fed will do is then come in again and start buying 10-year bonds to try and keep those yields as low as possible. And the question is, how long can they keep doing it for? How long can they keep printing money before the currency starts, absolutely going down and devaluing quite quickly? Cryptos, cryptos shouldn't be related to what's happening in fiat markets, but we have seen cryptos, trade pretty much, to the equity market, and it shouldn't be the case, right? Shouldn't be the case. Generally, as a rule, cryptos should be a hedge to the fiat markets. But, what we've seen is, yes, we've seen cryptos come back a little bit. Ripple back at 10%, and it's doing very well, XRP, compared to Bitcoin, Litecoin, Ethereum, Bitcoin Cash. Bitcoin up 8%. These normalized returns. Litecoin 13, Ethereum 19, and Bitcoin Cash 7. Ethereum is going to its new version of its 2 product, new version where they want to go to proof of source rather than proof of work. Again, Bitcoin Cash, you run the risk that if you're in Bitcoin Cash, there could be a 51% malicious attack. God knows why Litecoin's up so much to me, but Litecoin doesn't have a real business case at all. And don't forget, Bitcoin is halving, and so is Bitcoin Cash. But, again, Ripple, XRP should be doing better than anything. Seriously, anything, because it just has the runs on the boards with the clients and everything else. But it's a case of the overall markets not understanding the technology of Ripple. But the reality is the cryptocurrency market shouldn't really be affected by the fiat market. But in saying that, yes, all markets are connected by cash. So when there's times of implosion, people do tend to sell the asset that they can liquidate very quickly to cash. Okay, so that's pretty much what we have seen, right? So we know that most commodities are going down, but I suspect soft commodities like wheat, soybean, anything where you eat a grain, I suspect those will go up, because as you know, there's a massive shortage of flour on the shelves. People are actually baking. It's the same here and the same everywhere else. Apparently flour is in mass shortage, so you should see soft commodities starting to run up. Excuse me, I'll just have a glass of water. So food, in my mind, will go up even more, and that's the risk that we do see. Kyle Bass said buying gold is just buying a put against the idiocy of the political cycle. It is that simple, and I really like that statement, seriously, because the political cycle, the economic cycle of the people at the top have no idea, in my mind, no idea, and it's going to kill the currency, right? And gold is, a hedge against a declining currency. Okay, so the economic data gets worse and worse and worse, and yet stocks go up no matter what, regardless of the economic data. You can't have it both ways. If the consumer is not spending, and that's 70% of the Australian economy as well as 70% of the US economy, they're not spending, they're not buying anything, they're not supporting any businesses. The revenue of these businesses that are listed on the exchange, their profit and loss is going to be terrible going forward. But the Fed keeps pumping in money no matter what. And in my mind, it will end in a disaster, an absolute disaster. So, again, they talk about fundamentals. I mean, again, the balance sheet of the Fed, as I said, is now 6.3 trillion. In 2008, it was over 8 trillion. It's just going to get bigger and bigger. Stocks are more expensive now than they ever were, and they're going to get more expensive. And honestly, this is just going to go and end up in an absolute disaster going forward. Anyway, guys, I hope you're all well. Please do look after yourself. Please support each other. Please be kind to each other. Please be kind to your parents. If you've still got them around, you're so lucky. Or your grandparents, you're so lucky. God, I'd love to have my parents and grandparents around. Please look after your animals, your beautiful dogs. Please don't dump your animals. I love animals more than I love people. And please just don't lose your empathy. I know it's really hard when we're also worried about money and everything. It's horrible. I know it's really difficult, guys, but look, I'm there with you. I know it's bad. I know it's really bad, and we're all suffering. We just got to try and do the best we can. We have one life, and we just got to try and make the best of it. Anyway, guys, thank you very much for your support, and I really appreciate you supporting me. And please, really, I mean this seriously, look after yourself. Thank you, and thank you for listening, Susie, and I'll be back to you very soon. Thank you.